Okay, guys, Tom Lee made some very interesting comments about the stock market, and this is what he had to say.
Joining us now with this call for the markets on the first trading day of September is Tom Lee, managing partner and head of research at Fundstrat Global Advisors, as well as a CNBC contributor. And all along, Tom, when you've made these prescient calls, some of them even short term, it had to do with positive surprises on inflation. And is that going to be enough from here on out to keep the market headed higher, or have we shifted to growth worries now?
I think there's probably more growth worries in people's minds these days. So the jobs reports and claims seem to have more market reaction. I think that's going to be the case in September as well. I mean, we have the Fed meeting sort of in the middle of the month. But this week is the jobs report. I'm sure there's going to be a lot of focus on that. Right.
So what kept you positive was that the numbers were always, for the market, they were better than people were thinking. Is that going to continue to be the case? But it's no longer inflation. It's now growth. So growth will continue pretty good. Jobs will continue pretty good. You're not worried about another growth scare like we had 6 weeks ago?
Yes. I think that the growth scare is what everyone's worried about, because the July jobs report was kind of a shock to markets, and that's part of how we had that Tokyo Black Monday. I think this jobs report for August is going to show a nice rebound for growth in jobs. Hopefully it's not too strong, because, of course, as you know, if it's too strong, people are going to worry the Fed might backpedal on a September cut.
So where does that leave you in terms of what is seasonally, Andrew just alluded to it, September's not great, and we know, I mean, we always make lows in October, or we have many, many times, which means usually a lot of times September was not great.
I think investors should be cautious for the next 8 weeks. You know, September.
Next 8 weeks, be cautious.
Yes.
You're not always cautious.
That's right. When the market's been up 7 of the 8 months this year, so we know it's an incredibly strong market, but we also have the September cuts, and we have the election, things that'll get people nervous. I think in the next 8 weeks, people get a chance to buy. So I think it's good to be cautious, but just ready to buy that dip.
You have, because you're fearless, and you'll say anything, you have in the past actually talked about election-related trades and Trump trades. And do you see anything going on now that indicates anything to you? Bitcoin hasn't been acting very well.
Yeah, Bitcoin hasn't acted well. The two things we're watching to sort of look at how election probabilities are weighed is Bitcoin and energy. I think the fact that oil is being weak, even with some geopolitical risks, tells me I think the market is starting to bet more on a Trump election. But
because there'd be more production.
More production.
Bad
yes.
for price, which is not necessarily the way that you might think about things, because we hear about, we're at records for oil production. No one realizes the reason we're at records in this country is because prices were so high that it caused a lot more drilling and activity. And the prices were high because it's harder to drill without and LNG and everything else the Biden administration did.
Yeah, that's right. So people think oil should be higher here for many reasons, but oil's been weak. So I'd say that's probably the market.
That's China too, though, isn't it?
Yeah, China's becoming a bit more mysterious, right? There's even risk maybe of negative GDP there.
Okay, so the next, and funny you said 8 weeks. It's almost exactly 8 weeks, I think. What's that? It's like 63 days or so. So some uncertainty and caution going into the election, but in your view, people should get long.
I think they'll get a chance to buy long, yeah. So I think this is one of those where investors need to be cautious, but in the back of their minds know this is a strong market.
How far down? 10%?
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. So it's been testing investors' patience. But I think we should expect turbulence.
And then the question, of course, is when the turbulence comes, is it a buy the dip always? Or is there going to be and by the way, buy the dip at when it goes down by 2 or 3%, or you really actually have to wait for a 5, 6, 7% pullback?
I think 1 or 2 is just almost like daily noise. This market has shown, pullbacks like that. So I think something like a 5% pullback is very likely, but I think we do.
And are you waiting for that?
Yeah, I think it. You know what? We'll find out this jobs report, because like if it's too strong and investors worry, and so the stock market's down Friday, I would be buying that dip. But there's a chance that we get a good jobs report and the market's up. I hate to sound so binary, but I would just say at the bottom line is it's a strong market. So I don't think we've seen the top for 2024. It's just that the next 8 weeks are tougher.
So you heard what Tom Lee said. I'm going to break it all down for you in this video right now. But first, I have a huge announcement. This Friday, September 6th, 7 p.m. Eastern Time, 4 p.m. Pacific, I am hosting a free webinar. That's right, a 1-hour free webinar. You guys need to sign up right now as spots are limited. I'm going to teach you things you never thought possible. And not only that, I guarantee you will learn more in the 1 hour that you spend with me this Friday than you've learned anywhere else combined. I'm going to show you what all my students in the Discord are raving about. They are all up. They're all profitable. Even in a down market, most of them are still very well deep in the green, 20, 30, 40% compared to when they started just 2 to 3 months ago. If you guys are serious about taking control of your financial health and future, this is the first step. I was bankrupt only 5 years ago, but instead of talking about the things that I've been able to buy and places I've been able to go, let me show you a clip of my son and I and how important it is to him to have his father around all the time and have time and location freedom in addition to financial freedom. All right, son, you ready to go? Let's go. You got your iPad and everything you need? You know, financial freedom wasn't easy, that's for sure. So let me ask you a question, buddy. Yeah. How do you like riding in a brand new car like this, going to school and summer camp?
Good.
You like it?
I like it.
How comfortable is it? How do you like riding your dirt bikes and having go-karts and swimming pools and video games and your own video gaming setup? How do you like all that stuff?
A lot, because I get to play video games, dirt bikes, a pool.
And having a really big house in the country with lots of room. Yeah?
Yeah, I like it. I like it a lot.
And most importantly, how much do you like the fact that Daddy doesn't have to go to work? I get to be with you every day.
We used to have to go to work.
I know. I used to have to go to work all the time. Now I don't.
That's a good thing.
Yeah. Before the pandemic, Daddy used to have to go to work all the time. And now we're just together having fun every day with no stress, right?
Yep.
So you guys can see how important it was to my son to hang out with me and how important it is to have me around all the time. Whether you're a parent or a grandparent, retirement has no age specifics. Whether you're younger, older, it doesn't matter. If you want to retire, it is the ultimate freedom. And I'm blessed to be able to live that life with my children and be able to hang out with them and raise them. And I was able to retire at 39 just over 2 years ago. If this is something you are serious about, very limited spots in the webinar. Click the link in the information box below, sign up, make sure to check your spam and your email box for the confirmation. There's going to be very limited spots in this webinar. Last time, so many people were upset they couldn't make it in. Don't miss out on this opportunity. Friday, September 6th, 7 p.m. Eastern, 4 p.m. Pacific. I will see you there. So I'm going to break down exactly what Tom Lee was saying. You notice how he said the next 8 weeks is going to be somewhat risky, or maybe there could be a pullback. Well, that's because of the elections coming up. There's a lot going on with the elections, geopolitical issues, mainly because of Taiwan and China and Trump having a different stance than the Democrats on this situation. But without being too political, there's also other situations going on that are much more important to a degree because they're closer in time, like they're this week. We're just a few days away from the PMI services, which almost surely is going to be an improvement, as services has been a constant improvement, whereas manufacturing is having some difficulty. But most importantly, the jobs report is coming out this week. We also have Nvidia that dropped 15%, and because it shed almost $300 billion in market cap, this also tanked some of the market. So the market didn't drop just solely on jobs or PMI data. Nvidia was a big part of that, and it wasn't really a sell-off, it was more of a rotation. But without diving too deep into Nvidia, that's for another video. For this video, in the market specifically, we have to look at jobs. the jobs report is coming out this Friday. And the issue is, if the jobs report is significantly improved, one would think that would be great, right? We have more jobs being added, unemployment goes down. That's wonderful. It's a drastic improvement. Well, yeah, it's a great thing in one aspect, but what's going to happen is the feds are going to sit back and say, whoa, we already promised a rate cut in September. We're going to give them their rate cut, but we're not cutting rates anymore because the jobs are good, which means the stock market is going to get a little bit fickle and volatile because now investors are going to be like, wow, we're only getting one rate cut because the jobs are a lot better than we thought. Now, in the long run, in the next 3 to 6 to 9 months or more, it's not really a bad thing at all. It's actually quite good. But in the short to near term, it could be volatile because investors and institutions might sell off, or the stock market might be very volatile and bumpy and go up and down because of the fact that we may not get rate cuts if the jobs report is too good. I know that's kind of counterproductive. We don't want the jobs to increase and we don't want unemployment to decrease, because if that happens too much, we don't get our rate cuts. Now, on the contrary, to the flip side of things, if the jobs report is bad and it's actually a pretty steep decline, well, sure, that'll be great because the feds will go proactive and start cutting rates more aggressively. But on the other side of things, that's also a disaster and a recipe for a recession. So that's not good either. So ultimately, we want some smooth, small, consistent progress, and increase in jobs and decrease in unemployment. Enough where it's really good, but not enough where the feds won't cut rates. It's got to be in that sweet spot. I know that sounds like we're asking for our cake and to eat it too. Ultimately, that's what we need. And you heard what Tom Lee said. Every single year we have 2 to 3, sometimes 4 pullbacks. A couple of them, maybe 3 of them are 5%. You have one major doozy that's 10 to 15%. This year we already had 3 pullbacks, and 2 of them were pretty big and one was over 15% or more. So the market is really strong. We spent 7 out of the last 8.5 months this year up. We are up. So it's a strong market. It really is. I don't think we're going to have a whole lot more of a pullback than we already had yesterday, but there, like Tom Lee said, there is a possibility we could see another 2 to 5% pullback over the next week or two, but it's a buying opportunity. Buy the dip. Look, I explain this all the time. They want to shake us out of our stocks. That's what they want to do. Every time you get in a position where you're losing money and you sell the stock, sometimes within a few hours, a few days, or maybe a few weeks, the stock just goes up. It's usually within a couple of hours or a couple of days. You get out on Tuesday or a Wednesday, and Friday or Monday, the stock's right back up again. This is the issue. Hedge funds, institutions, insiders, market makers, they all know how this works. They have algorithmic bot trading, which overreacts. Everything has slippage going on. Your sell orders are getting slipped. People are getting stopped out, and the price just continues to tank. Then as it flattens out, they buy it up. The stock price rises. You're selling right there at the bottom when it starts to come up, taking, less loss than you would have, but you're still taking a loss because the price has come down. You see it coming back up. So you're just cutting your losses at that point, or you're selling as it's coming down, one or the other. But typically that's what happens. The stock price starts to come down. You start selling. It levels off. They start buying. It starts to go up. Then you start buying back in again. It goes up a little higher. Then they sell. So you're constantly buying at the top, middle to top, and you're selling middle to bottom. So you're breaking even or losing money, sometimes a small profit, whereas they are printing money. This is a psychological aspect of the market. When things sell off, like the pullback, we wait for confirmation that there's consolidation and reversal and things are stabilizing and starting to go up just a little bit, and we start buying the dip and we dollar cost average. This is the best thing we can do. If you have NVIDIA at $110, it drops to 95, add 100 shares, drops to 92, add 100 shares, then sit. Your average price at this point is going to be close to 100, under 100 at that point. So once it goes back to 105 or 110, you're making pure profits again. You have to know how to time the market, and sometimes that can be very difficult. But ultimately, if PMI services is up this Friday and jobs report data is also good, but not too good, but good enough we still get the interest rates, and it's a good jobs report, we'll see a pretty decent run on Friday. I think we'll get back some of the loss that we had yesterday, maybe all of it. It's hard to say, but I think there'll be some good bullish action happening on Friday. And then in the coming weeks, it'll get a little bit better, but there's going to be a little bit of a sell-off on the 3rd week of the month when FOMC Fed meetings happen during rate cuts. So I expect we could have some recovery this Friday if the job reports are good. Then we're going to consolidate. There could be some volatile action in the next 2 weeks, but probably more of a neutral to slightly bullish as we get closer to the FOMC meetings in the middle of the month, near the third week, this is where things get interesting. Things could get even more volatile, more bearish. Some sell-off could happen. Once the rate cuts are confirmed, then the stocks will start to rise again. But ultimately, we're looking at good job data, good services PMI, and then a rate cut. By the end of the month, we're recovering. Going through October, there could be some more recovery, if not more bullish run. And then as we get into elections, as long as nothing crazy happens, then things will get even better. I think mid-November to end of November, things start to run. Christmas time, I really expect the stock market to be a few percent above where it was before the drop yesterday. The price target, the special number that Tom Lee has for the S&P is 565. If the S&P breaks 565 to 566, this is a really good spot. If this happens after the rate cuts or even before, that is a very strong bullish signal. There's a chance that may not happen until October or later. But once that does, we could have a nice run before the end of the year. All in all, is the market crashing? Is it tanking? Is it imminent? Well, geopolitical issues have kind of wound down over the last couple of weeks to a month. Volatility in the VIX were down until yesterday. We had some shakiness due to PMI data coming out yesterday. Now we have jobs and PMI service data coming out later this week. Things weren't as expected as the reports weren't that good on PMI manufacturing. So that's the issue that we faced yesterday. Like I said, the election and rate cuts are coming up. Rate cuts near the end of this month or the third week of the month, and elections just a little over 2 months down the road. So there's a lot going on, a lot of fear and a lot of shakiness and volatility in the market. If this stuff confuses you and you don't quite understand all the things I'm talking about in this video, you guys can sign up for my full training course, Discord, and one-on-one coaching. This way I can help you understand all of this so much better. All of my students that sign up for coaching and Discord and my training course are up 15% their first month and usually 25 to 30% their second and third month. If you guys want to take control of your financial freedom, you can do so at any time at investorcorey.com, right there on the screen or in the information box below. I'm driven every single day to help people just like you achieve their financial dream and goals. So really, the issue with the market is pretty simple. People are scared. It's volatile. It's shaky. But I don't see this being another massive pullback. We've already had a couple of those and the market still stabilized. Things very well could get aggressive and have more of a sell-off, or we could have a bullish run. It's really hard to predict the movement of the market. Time in the market beats timing the market. It's really an investor's game when things like this happen. You play the long game. It's a buying opportunity to go long on shares or maybe leap options, but I really prefer shares. I ultimately would not panic. I've told you guys 3 separate times over the last couple of months when the stock market pulled back heavily the last time at the beginning of August, buying opportunity. And what happened? Fast forward a few weeks later, everything's in a sea of green and we made all kinds of profits. Do not fear when you see red. That's the time to be greedy. When you see lots and lots of green endlessly, that's where you have some fear and you look for an exit to sell. Don't let the markets confuse you and shake you out of your shares or manipulate you into selling. I want you guys to be strong. Everything will recover. In due time, things will all work out in the stock market. This is just a buying opportunity. Like I said, guys, free webinar this Friday, September 6th, 7 p.m. Eastern Time, 4 p.m. Pacific. Absolutely free. Very limited spots remain. If you guys are interested, sign up. The link's in the information box below. Check your email and your spam folder. Make sure you are signed up. Like I said, guys, very limited spots. Last time so many people did not make it in. You are going to learn more in the 1 hour with me than you will anywhere else. I pretty much guarantee it. I hope you guys are going to join me and I will see you there 7 p.m. Eastern, 4 p.m. Pacific. Friday, September 6th. I have a huge announcement during this webinar and I will have a Q&A to answer your guys' questions and hang out with you. This is an opportunity you don't want to miss. I picked out another video for you guys and that video is right here. I'm in 2 places at once and I hope to see you guys over there. And remember, until the next video, let's grow our wealth together. Take care, fam, and we'll see you on the next one.